A new high, record high inflation once again. Are we tired of hearing about this yet? Today we got the CPI number over 9%, 9.1% on the headline. So I'm going to pull up mortgage charts just so we can get a reference on what this means to markets. So right now, mortgage bonds are actually flat, which is a huge improvement because if we go to the chart, on the initial reaction when the CPI report came out, bond prices fell significantly, which started the day off about 50 basis points lower, has since recovered. Mainly these reports come out on the headline, and then there's a lot of data that goes into the report that traders have to kind of take in and figure out what are they going to do. So if we just talk about rates overall, we're going to show the chart on the 10-year Treasury first. So some significance is happening right now. The CPI report brings a lot of this right to the forefront. So 10-year Treasury notes are currently yielding 2.937% as of right this moment for bond investors that want to invest in a 10-year security. They can take that same money and invest it for 1 year and actually get a higher rate of return at 3.16%. If they keep the money locked up for 2 years, they're getting 3.1%. The 7-year is getting over 3%. And the 30-year, the longest end of the curve, is over 3.14. So the 10-year typically on the mortgage end tracks kind of the direction of rates. So if we just take a look at this chart, we saw the highest point on the 10-year actually back in June, around the time of the last Federal Reserve meeting where they raised 0.75% on their federal funds rate. So shortly after that, bond markets calmed down, at least on the 10-year side. Okay, so they've slowly gone down. We hit a low at the beginning of July. It's since bounced back up. And today we're actually improving. We're lower and below the 50-day average for the 10-year Treasury. So that's a positive thing going forward, potentially for mortgage loans. But what's happening is this inverted yield curve, you'll start to hear more and more about, is something that occurs over time, and in history that has shown to be an indicator of a recession. So this is the big talk. This is what the news heads are all talking about. We've talked about recessions likely being identified here just in the recent little short period of time. If we just go back a year's time, this represents the 10-year minus the 2-year Treasury yield. So this is representative of an inverted yield curve. Happened on March 31st, where the 2-year Treasury was yielding a higher rate of return than a 10-year. Happened very shortly on March 31st, and then it came back around. We did find out a couple of months later that first quarter GDP was negative, and then just in the last couple of weeks we had an inversion on June 13th, and then a more significant and more pronounced right now in the inverted yield curve. This over the history, if we just go back to the maximum, when this happened back in 2005, and it stayed that way until 2007, and ultimately a recession occurred afterwards. Okay. This happened again back in the early 2000s, January 2000. It remained inverted until the end of that year, December 28th. Then in 2001, there was a recession. It did happen for a short period of time in 1998 and did not result in a recession, right? But not a described recession based on the parameters set aside by the economic folks that call that. But if we just go back to the 80s, similar thing happened. We go back to 1977, similar thing happened. Recessions occurred. Bottom line, the Federal Reserve, what they're doing right now is they're raising their short-term interest rate. They're trying to put the slowdown on the economy. They don't want the heat of the economy, this hot inflation, to calm down. And their only real tool to do that is significant changes in their federal policies on their interest rates. So over the next couple of months, we're probably going to see more continued high inflation. These numbers will come out, headline numbers in 9. Some say that they could hit as high as 10% on the headline number. The Federal Reserve focuses on the core inflation, which takes out your gas prices and energy costs, which is a significant driver of this high inflation. And there's nothing the Federal Reserve can do about it. So what we're going to be is on a hot ride here until the fourth quarter, where we're likely going to see a slowdown in the economy, a slowdown hopefully in interest rates, where they could pull back if we see a significant pullback in inflation. And unfortunately, that will mean a pullback in economic activity. Have a great week.